Welcome to the All Financial Hour podcast with Steve All.
Some good news here is that if you've struggled to get 10,000 steps every day to stay healthy, there's actually a study that says you really just need as little as like 7,000 steps to get the same benefits. I mean, after what you just did, how many steps did your watch calculate, Steve?
My watch, I didn't keep it on my watch, but I did do it because my mother-in-law asked me, how many steps do you take doing that? And I opened it up. It was 100,000 steps in 32 hours.
100,000 steps in 32 hours, essentially 10 times what you've always heard, right? Get 10,000 steps a day. This study says you'll get the same benefits if you just hit 7,000. Steve, you're an overachiever. Congratulations on that.
Thank you very much.
And speaking of those numbers, it reminds me of trying to calculate how much savings you're going to need to retire. I mean, some shoot for like the magic number. A lot of folks say it's 1.8 million. Others believe you should have about 70 to 80% of your annual salary. So have people been coming in and thinking, all right, I need 1.8 million to retire, Steve. How can I do this?
I think the biggest mistake that people make is they've got this number in their head that they need to retire. And it's to me, it boils down to what's your lifestyle cost? What's your guaranteed income? If you've got a pension and Social Security and that meets your lifestyle, the number of assets that you have at the top is for the extras, inflation that comes along that way. Now you got the people that go the other direction. I don't have a pension and I have an income that's a little bit high. My income is not as high as my expenses. Well, if you got a gap there, how do we fill that gap? Well, there are basically three ways that you could choose to fill the gap. One, buy an income stream. Guarantee it. That guarantee would come from an insurance company. That would be an annuity with an income rider. And if I put my money there, I've got that guaranteed income for the rest of my life. And if I want it for me and my wife, it's for both our lives. Two, we could just take money out of your account. You know, the 4% rule, a lot of people talk about that one, where I'll just take 4% of my total portfolio. I like to add 2 to 3 years to it because you might have one of those down years right at the beginning when it comes to it. Third way, put a stock or a bond fund together where you take the money off of that and you use that for your spending money each year. A lot of times we'll use combinations of each one of those. It's all going to depend upon you and your situation. But the question that I usually ask people that are sitting there, have you thought about how you're going to replace your paycheck in retirement? Have you heard of all three of those options? Which one would make the most sense for you? It's all going to depend upon how many assets that you have and how we want to do it. How is it done? Is it all IRA accounts? Do we have some of it Roth? Or do you have some of it non-qualified? Makes a big difference. Income planning is probably the one that most people don't look at.
You know, back in April, the stock market went down almost 20% in just a few days. Then it bounced back in a week, and now it's near the highest point of the year. But if you panicked and you sold, you might be wondering, what do I do now? Well, there's an MIT study that found that the people who tried to time the market, they got burned. 30% of those were out of the stock market for good. Well, what would you tell someone who sold during the crash, Steve?
Different stories on that. I'll get to that. But I think the best story I've ever heard on this was probably about 3 or 4 years ago. Gentleman said that during the crash between 07 and 09, he said, I looked at it and he goes, I figured the market wasn't going to do what it needed to do. So I went ahead and got out. And he goes, I felt really, really smart when the market dropped all the way down to where it was at in 2009. Felt really good. He said, but every time I thought about getting back in, it was like, what's going to happen again? And he said, I never got back in the market. So he missed the run-up from 2009. That phone conversation was in 2019. So he had missed 10 years of market gains. He didn't know when to get back in. And that's what I really love about the system that we use, MarketGuard. I'm going to talk about that in a minute. But if you made that decision to pull, I'm going to say, let's sit down and reassess your risk tolerance, because you should be able to take some up and some down. And we want to make sure that you have a risk-adjusted portfolio. So that would be the first thing I'd look at if you pulled out in April. Second, trying to time the market, it doesn't work. Saying, I'm going to buy it here, I'm going to buy it there. As I said, this guy thought he was going to get out, get back in, and he couldn't. Another way that you can do it is dollar cost average back in. The biggest suggestion I would say, give me a call. Let's sit down and look at your situation, how much money it is, and figure out the best way for you to get back into the market. And that's where MarketGuard, I think, comes in, because the mathematical models, non-emotional, tries to take some of the emotions out. I can't get all the emotions out of investing. I wish I could do it for myself, and I can't. So I know I can't do it for you. But if I've got that non-emotional, methodical, mathematical formulas that tell me those three major things that most people are looking for. Steve, when do I hold? When do I sell? And if I did sell, when do I buy back in? Those are the three things that most people are looking for. So if you're looking for any of those things, give me a call. Ask about MarketGuard. Let's look at your risk tolerance and sit down and look at an investment that you can be comfortable with, and it helps answer those questions. Should I hold? Should I sell? And if I did sell, when did I get back in?
You know, on this show, we talk a lot about annuities, but do you really know what they are? Well, here are some folks, and they answered the question for us.
I know what an annuity is. Yeah, they're an excellent retirement benefit for a guaranteed income.
Well, I know what an annuity is. I think there's many types of annuities. Some are good, some are bad. It just depends on what restrictions there are with the annuity and the fees associated with the annuity. The fees are the big thing.
All right, so Steve, right here, right now, let's set the record straight about fees and annuities so we don't have to address this ever again. You're going to tell the people which annuities have them and which do not.
I don't think that's going to happen, because we address this on a regular basis. I love the people that come into me and say, I hate annuities. And I look at them, I say, I don't like some of them either. Which kind do you not like? And I get that deer in the headlight look like, what do you mean? What kind do I not like? Mm-hmm. There's 4 different types of annuities out there. Mm-hmm. You know, you have the fixed annuity. A fixed annuity is where, with an insurance company, you're going to give them a block of money, and they're going to pay you a percentage called interest for however many years you buy it for. It looks a lot like a CD, but it is done through an insurance company, not through a bank. So that's a fixed annuity. Fixed rate, fixed amount of time. Second thing that you can do a single premium immediate annuity. That's the one that most people dislike. That's the one where people tell me the horror story. Uncle Joe passed away years ago and the insurance company kept his money. And that is a single premium immediate annuity. You have traded some money for an income stream guaranteed for the rest of your life. And if you want to include your spouse, that would be joint. So that is a single premium immediate annuity. Now, years ago, they did. If you prematurely passed 2 or 3 years, the insurance company did keep people's money because that's how the contracts were written. Well, that became a problem. Nobody liked that. So now they usually have 5-year certains, 10-year certains. There are other things that can happen with that annuity product so that it makes it easier to do. So we don't have that. I gave an insurance company my money. 2 weeks later, I died, and they kept all my money. So that one goes away. Variable annuity. Variable annuity, your money is in the market. It is in the market. It's going to go up. It's going to go down. Within variable annuities, there can be more expenses because of the fact, one, you have a management fee. They have somebody picking the funds that are in there for you. So there's an internal cost for the management fee. They also have fees that adjust, and there are some guarantees that say, if we lose the money, we're going to pay you as if though you didn't. So that's the part from there as it goes from there. The fixed indexed annuity, your money's not in the market. They're not guaranteeing that you're going to make anything, and they buy an option. And if that option goes up, guess what they do? They go ahead and exercise the option, and you get paid the interest. If the market goes down, there's no losses. You cannot lose money due to market volatility in a fixed indexed annuity. That's floor of 0. But if you got a floor of 0, you're going to have some ceilings. You can't make everything. So depending on which kind that you get, and there's a lot of them out there, the thing that I think goes with the variable and with the fixed index is an income rider. If you have an income rider, I can promise you it's going to cost you something to get it. They're going to pay you as if it was a certain amount, and they're going to keep paying you even if the account value goes to zero. That's what you're paying a fee for. So you do have to watch the fees. So I am going to sit here and say it depends on what you want to do. If you're looking for guaranteed income, that's one type of annuity. If you're looking for protected growth, I don't want anything less than a zero. That is a fixed indexed annuity. Two different products, two different goals. Not very many companies have anything that can do both. So if you're looking for either one of those, I want the, quote, protected growth, or I want that guaranteed income.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.